Now, for all of those who are looking ahead as to whether it's going to be Trump, whether it's going to be Clinton winning the elections, time will tell. But it might actually pay to look retrospectively at whoever wins. There's what I'm calling a poisoned chalice disadvantage.
So, can you tell me about some of the latest price reversals and what kind of risks they could lead to?
Well, winding back to the first week of September, we did have that minor but sharp correction following a 2-month low volatility period. What is most important is the timing of it. And as there are seasons to the year, there are also seasons to the investment landscape. And right now we're in that negative seasonality, which is the month of September, moving on to October. So this tends to be quite a precarious time for the equity market. So it's something to watch out right now. In price terms, what's key is that so far we did break below the previous all-time high, not the most recent one, but the one posted in spring of this year. At the risk level, they're at 18,350 on the Dow Jones Industrial. We're trading in and around that level, but if we fail to hold above that level, that will suggest further downside risk of roughly minus 10%.
So what kind of seasonal patterns can you tell us about the third quarter? This
Q3 autumn-fall crash cycle works as the best performing cycle over history. It doesn't always work every single year, but it does matter, of course, the context and the overextension of the market as well. What we see is that the greatest risks that we've seen in the last few years has been last year in 2015, when we had the correction following the Chinese bubble burst of about 13% on the US equity market. Then in 2012, a drawdown of about 17%, and the biggest of them all in that period during the 2008 global financial crisis, where part of that downside risk was between autumn and October, and that yielded minus 34%. So history might not repeat in exactly the same way, but as we do say, it'll likely rhyme in terms of price and timing.
Now, the US election is inching ever closer. What kind of impact will this have on the equity markets?
Well, on the previous slide, we've been talking about the price and time setup, but more on the short-term tactical basis. If we look at the higher time frames for increased probability of what will happen, the roadmap becomes even more clearer when we look at the presidential election cycle. Now, most people look at the first year, going into a new year of a presidential election, as being positive. That new president is given what we deem a honeymoon period, where people are a bit more optimistic and sentiment tends to tick up, and equity markets tend to be positive. But this year is different. That's because we're in the final year of a second-term president, Obama. There are many presidents that have followed in line. Think of Clinton, think of Bush, and going back 100 years, this back tests, without exception, that the final year of any second-term president tends to yield a negative end-of-year performance in the equity market. Now, for all of those who are looking ahead as to whether it's going to be Trump, whether it's going to be Clinton winning the elections, time will tell. It might actually pay to look retrospectively at whoever wins. There's what I'm calling a poisoned chalice disadvantage. There's a lot of legacy pressures, not least in an inflated equity market, with potential pressured economic business conditions that president will have to pick up on. And so history has proven that that tends to be overwhelming to a new candidate. And the average year-to-date performance in that last year is minus 13%.
Well, thank you, Ron, for joining us from the Swiss Association of Market Technicians.
Thank you very much.
And thank you at home for tuning in today. Don't forget to give us a like and a comment in the box below. Goodbye for now.